New order placed to sell short Canadian dollar at 135.061. So order placed to sell short at 135.061. New position open at Canadian dollar. Short position at 1.35061.
Deal done. EU leaders agree a €750 billion coronavirus recovery package after more than 4 days of tense negotiations. The worst may be over. UBS signals the peak of the crisis is behind it as a Swiss bank considers reviving shareholder payouts. We'll hear from the chief executive, Sergio Armotti. And Novartis trims its 2020 sales forecast on pandemic disruption. The group's chief executive tells us he's cautiously optimistic about a COVID vaccine. Well, good morning, everyone, and welcome to Bloomberg Surveillance. I'm Francine Lacqua here in London. Now, the markets are moving sideways a little bit, but they're still quite optimistic about things to come. This is what I'm looking at overall. A lot of the focus, of course, on the markets. If we can get the board up for you, is dollar weakening, but actually stocks advancing globally. Also, U.S. equity futures are up after these European leaders reached a deal on the landmark stimulus package. And if I look at equities rising also across Asia, Australia, for example, outperforming after the government boosted job subsidies. So after 4 days of tough talks, European leaders have agreed on a landmark stimulus package that will see the bloc issue €750 billion of joint debt. The emerging
I'm placing an order to sell short euro at a price 114.416. So order placed to sell short at 114.416.
And we are getting one today, even if, of course, as you...
New position open on euro at 114.416. Short position.
7 years. So overall, it's your typical European compromise where every country will tell you it's a good deal for their government, their taxpayers on the country, and it's overall a good thing for the European Union.
Thank you so much, Maria Tadeo, there in Brussels for us. Now, joining us this morning is Andrew Sheets, Chief Cross-Asset Strategist at Morgan Stanley. Andrew, great to have you on a pretty momentous day. When you look at the stock market performance, they seem to be okay with the deal. How long can it last?
Yeah, well, look, I think it is important to step back and appreciate that this is a very big deal. It's very significant. It's, I think, been surprisingly close to the initial proposal, and it's happened quite fast. I mean, even though I felt, our call at Morgan Stanley was quite optimistic around the deal getting done, we still thought there was a good chance it might take kind of a second session, to kind of finally wrap things up. So the fact that they did it in this round is good news. And I do think it's helpful to the European story, where European assets have lagged for a long time, where they're generally cheaper. And so I do think that we can see some sustainable outperformance from the euro, from European equities here over the coming months. I think the bigger concern is that, this is one of several positive things that's happening in July, along with earnings season, along with maybe another U.S. fiscal package. Once we're out of July, those positive events are behind us. And so I think I'm more concerned in that August-September period, what's going to be then the next catalyst to take kind of the broader market higher.
Yeah, and Andrew, you basically argue that over the next 2 months, the positive catalysts fade, there's seasonality getting worse, and near-term risks emerge. What does that all mean for stocks?
Yeah, so I think it means a tougher period for stock markets. So there's that old saying, which is a great saying, that it's better to travel than arrive, and I do worry a little bit that as you're into August, you've arrived with a number of these factors that we're having a pretty good earnings season now, but that will be behind us. We've had a very successful European summit, but that will be behind us. That we do think that the U.S. will pass another round of fiscal stimulus around the end of the month. But again, that will be behind us. And even I think some of the good news on vaccine development, which is certainly very encouraging. Again, the kind of the phase 1 data will be behind us, and it will be some time while the market has to wait for what are the results of the phase 3 trials, which we think we might not get until sometime in October. So it's that kind of gap in news at a time when we do think there's some rising risk that some of the economic data momentum softens a little bit, and that you're into a period where, at least for U.S. assets, kind of August is when you can often start to see some worsening kind of pre-election performance, that the market starts to care more about the U.S. election. It's harder for people to take on new investment ahead of the election, and I think a lot of investors just decide to wait until they know the result before making their next investment.
So what are your top picks, Andrew? Where do you find value from here? What kind of strategy should we be looking at, given that, I guess, some of the safer stocks are also look expensive?
Well, that's a great point. I think complicating this, I would love to say, that we're the only ones who are concerned about, a slowdown in growth. I think the market's very concerned about a slowdown in growth. I think you see that in where bond yields are. I think you see that in where volatility is. I think, exactly as you mentioned, I think you see that in how much a lot of these defensive stocks have outperformed. So it doesn't, I think, do.
Stop on profit for Canadian dollar at 1.35041.
Valuations in Europe are very reasonable. You don't election-related risks. I think also cash corporate bonds have a very positive dynamic behind them, in that you've had very heavy issuance of this debt from April through now, as companies have kind of rushed to grab financing while it was available. We think that now slows a lot, and so you'll just have far fewer bonds coming into the market, which could help some of that performance and some of that supply-demand imbalance in the corporate bond market.
Andrew, do you buy what central banks buy? Is that still a good strategy?
I think you can wouldn't credit it is because I think there again you could have this kind of dual dynamic of the central banks are supporting the markets and providing a backstop to the market, and supply is then slowing down. But I think the tough thing there is I think if we look at, say, the government bond side, central banks have already pushed real yields down to record low levels. That obviously I think reduces the risk reward. And I'm actually very curious because I think it's actually very hard to tell where expectations are for the Fed meeting next week. And I think that we don't expect the Fed to announce any major new action at that meeting. That's our expectation, but I think investor expectations are actually quite varied about what they're expecting, and so to the extent that if they don't do anything, does that come across as actually a little bit of a disappointment is, I think, a kind of a big unknown.
Andrew, thanks so much. Andrew Sheets there from Morgan Stanley stays with us. Now, coming up, the tech trade comes roaring back. We'll talk big rally in the NASDAQ with Andrew Sheets. That's coming up next, and this is Bloomberg.
We close position on Canadian dollar at 135.041, profit £200.
It is critically important that the markets stay open in this time, as opposed to trying to take breaks in the middle. I think that that'll just push off the situation a little bit, but actually could create other